Hey guys, it's Jimmy Kerr back with video number 4 in our series on the mortgage loan process. Today's video will focus strictly on the products that we offer here at My Hometown Mortgage. And it's probably going to be the one I would think that most people will find the most interesting because it does talk about all the different products that we offer and kind of the qualifications for each one of those. Now, the next one that I'll do in this series will focus on payment, and we'll actually roll through the payment on each program that we talk about today and try to show you what those payments look like and kind of how they vary. But today I'm going to hit the highlights on all the programs that we do offer. So you've come in, as we talked about in the previous videos, you've applied, we have you credit qualified. We've gotten some documentation from you, and now we're talking about what kind of loan program is best going to suit your need. Okay. So the biggest question I get asked probably on a daily basis as far as it pertains to a loan program is, do you have anything with no down payment? I'm a first-time home buyer and I don't have a down payment and I need something with 100% financing. And the answer to that question is yes, I do. I do have some 100% products. Now, I do want to say that one of the most common questions is, I'm a first-time home buyer. Do you have anything for first-time home buyers? And there's not really what I would consider to be a first-time home buyer loan. There are loans that most first-time home buyers use, which is USDA Rural Housing and FHA. But I don't know that there's a specific product out there for a first-time home buyer. I've always said it's more of a marketing thing. Like you drive by and you see a My Hometown Mortgage sign and it says, hey, we do first-time home buyers. And you're like, hey, I'm a first-time home buyer. Let's go there. So, but most people are using one or two programs if they're a first-time home buyer, and that's USDA and rural housing. So, and we'll get into some detail with those here in just a second. So I always like to tell people that up front. It's a common, question that I get. So let's talk about the programs themselves. All right, so there's 4 major programs that we deal with on a daily basis. And this is the order in which I go when I'm talking to a borrower. There's VA, USDA Rural Housing, FHA, and conventional. All right, so those are the 4 major programs. I'll say them one more time. VA, USDA Rural Housing, FHA, and conventional. All right, so one of the very first things I'm going to ask you when we're just starting to discuss loan product is, hey, are you a veteran? And if you are, number 1, thank you for your service. 2, the Veterans Administration has a really, really nice product for you to work with when it comes time to buy a house. The VA loan is a true 100% loan, meaning you can borrow 100% of the purchase price. Now, you do have to pay your fees, or they have to be paid by the seller or worked into the sales contract somehow, but it is truly a 100% loan. But what really makes that loan nice and special, and we'll get into some detailed discussion about what private mortgage insurance is, but that particular loan does not have private mortgage insurance. It's huge. It's a big deal, guys. When you're looking at a loan, if you're a veteran, and it makes the house much more affordable. I mean, depending on the product, it's going to save you, and the size of the loan, I mean, it can save you anywhere from $70 to $150 a month. So on the actual payment itself. So it's a big deal. And I really like doing VA loans. And again, as I'm corny, everybody knows this that knows me, I'm incredibly corny, but I love to do VA loans because I like to give back to those that have given to us. And I think that's a big deal. And it's my job to make sure that the veterans are taken care of because they watch over us. So quit being corny now, but that's the VA loan is really, really nice for our soldiers and men and women that serve in our military. It really is. Good product. 100% financing, no PMI. Those are the big highlights for that. Credit score wise on a VA loan, I do have some investors that can go down to 580. And we really look hard at those. Pretty much any veteran that applies, we look really hard. I do have some investors that'll even go lower. They'll go down to like 520 on a credit score, but those are pretty difficult to get approved. The hoops you got to jump through to get those done are pretty difficult. Now, if there's some other lender watching this or someone somewhere else, those are my investors, okay? There are other investors out there that may be able to do something different than I can, but that's what here at My Hometown Mortgage, that's what we can do when it comes to a VA loan. So VA, great program. All right, so if you're not a veteran, Then we're going to move on to what we call the USDA Rural Housing Program. Now, you'll hear that called RD, Rural Housing, 100% financing. You'll probably hear me call it RD a lot because that's what I seem to call it the most as we talk about it. RD is the next program, and it is, again, one of our most popular programs, and here's why. It is a true 100% loan. And what I mean by that is you can borrow 100% of the purchase price and the closing fees, the homeowner's insurance, the whole deal. You can literally borrow the whole thing, okay, into one loan. You don't have to come with anything. And most of the time, if you had to pay an earnest money deposit, I can get that back for you too. So it's a really good program. Now, the catch with rural housing is that it is an income-based program, meaning that you cannot make above a certain amount of money and qualify for that loan. And you actually have to do 2 income qualifications for rural housing. One for the loan, so you have to determine what the debt ratio is, how much money you bring in versus what you pay out, and you have to meet certain guidelines for that. You also have to do basically an income calculation for the household. So let's just say that you've got husband and wife and a son who's 19 that's going to live in the house. I actually have to document all 3 individuals' income and add them all up and make sure that they do not go over the income requirement for that particular program. Now, for a 1 to 2 person household, it's roughly 75.2, and then it goes up to 3 to 4 person household up into the $90,000 range. So we have a lot of people qualify for it. But yeah, it's a real nice program, but it is income based, and that is something that we do. Generally, when you're looking at RD, we're going to ask you to get us your income documentation up front. And we do have to calculate the income for anybody that's going to live in the household. And there's an income calculator that we use through RD that's used as well, predicts future incomes, things like that. So it's something that we definitely do up front on that program. But as I said, 100% financing, awesome. PMI on that particular loan, and they don't call it PMI. I think they call it the Rural Housing Guarantee Fee. There's an upfront fee that's actually financed into the loan. That's pretty much a given for any government product. And then they have the lowest monthly premium that you will pay as far as what I call private mortgage insurance. So it's a very attractive product from a payment standpoint, the 100% standpoint, the whole deal. Now, credit score on that one, you do have to have a little better credit score. Again, for My Hometown Mortgage and the investors that we use, generally you have to have a 640 or above credit score to have your best shot. What I would say that you've probably got an 85-90% chance of being approved, maybe even higher than that, if you're below the income level. Below 640, you have to have rented for at least 12 months. You have to have a housing payment history of some kind, and usually we look at rent for the last 12 months to be able to go below the 640 credit score range. And we can go down as low as 600, and we do. We're getting ready to close one. So we do those all the time, but that is something that you got to keep in mind from a credit score standpoint. Generally, it's got to be a little stronger, and if you get below 640, you're going to do what's called a manual underwrite, and it's just a more difficult underwrite, and the debt ratios that are allowed and things like that are lower. So, but it's a very, very strong product, and it is something that we do a lot of. All right, so let's say that you're over income for RD and you're not a veteran. So the next program that we go to will be called FHA. And FHA is probably the loan that we do the majority of. I would think most lenders, it's probably the loan that they do the majority of. FHA credit requirements, we can easily go down to a 600 credit score in most cases. Again, there is some times where you have your manual underwriting standards, but for the most part, FHA, probably one of the easier loans to actually get approved. I wouldn't say it's easier to document. None of them are easy to document these days. But as far as a true approval, FHA is one of the easier, I think, to get approved for. So FHA has a 3.5% down payment requirement. All right, so you're going to have to pay 3.5% down, and then you're going to have to pay your closing fees or work on getting closing fees paid by the seller or added into the contract in some way. And we can talk about how that's done at a later date. But that's what you're looking at. You're going to have to pay 3.5% down of the purchase price plus fees, unless you can get the fees worked into the deal somehow. So again, it's a popular loan. We do a ton of them. One thing I guess I really want to focus on with FHA is the down payment. And this is really for pretty much any loan that you're doing any kind of down payment on. If you take anything from this video, if you're listening to anything I say, listen to this. If you're making a down payment, we have to be able to source and document that money. Cash does not work. Okay, and I know you're sitting there, we're in Eastern Kentucky, and you're sitting there looking at me like, dude, you're crazy. I have 10 grand under my mattress. Well, I do too, not 10 grand, but I have money under my what we call mattress money. We like to deal in cash. But when it comes to doing a mortgage loan and documenting a down payment, I can't use it, period. Money has to be in your account for a minimum of 60 days. Okay, so it has to be seasoned. You'll hear that term, seasoned. That's what we're talking about. Your money has to be in your account for a minimum of 60 days. Or we have to be able to document the source of it. Are you getting it from a 401k withdrawal? Well, that's easily documentable. We can do that. Is it a gift? That's fine. On an FHA loan, a gift is fine. Has to be from a direct family member, mom, dad, aunt, uncle, brother, sister, somebody close, and we have to be able to document that money as well. So we actually have to get a copy of the bank statement for the donor that's giving you the money, and we have to be able to source that too. We have to be able to make sure that they didn't just take $5 grand or you gave them $5 grand and stuck it in the bank and then they gave you the money as a gift. Can't do that. So again, if you're not listening to anything I say, listen to this. Down payment money has to be documented. Cash does not work. If you're sitting there thinking about buying a house in the next 2-3 months and you've got cash and you're like, hey, I'm going to use this for my down payment, you better get it in the bank because we will not be able to document it and it will delay the processing of your loan. And most of the time we won't even start until we can source the actual down payment money. So FHA, again, with the payment, credit score wise, it's one of the, I think, easier ones to do. Payment wise, it's going to be a little higher because you got a little higher PMI premium, but it is still a really, really solid loan. Now, the last one is conventional financing, and we generally look at conventional financing if you have a larger down payment. You can get a conventional loan with a 5% down payment, but I said for us anyway, the rates tend to be a little higher on the conventional loans. But the nice thing about them is that you can get out of the PMI, the private mortgage insurance, at some point. So if you pay 20% down on a conventional loan, you don't have to have PMI at all, okay, from the beginning, no PMI. If you pay 5% down or anything less than 20% down, let's say, once you reach the 80% loan to value mark, meaning your balance versus your original purchase price, once you reach the 80% mark, then you can make a request to have the PMI taken off. Now, I'm sure that the investor, the servicer, whoever you're paying your payment to is going to have some requirements for you, some hoops for you to jump through. Seems like all this stuff does. But they will take the PMI off. Now, at 78%, again, as long as you're doing what you're supposed to do, making your payments, then it'll automatically go away. And that's one of the major differences between all the products and why you look at conventional financing sometimes versus FHA. Because they're probably the closest as far as the type of loan, down payment, and the way the payments are structured. They're very similar, FHA and conventional loans are. Generally, FHA wins because it has the lower down payment. But with conventional financing, you can actually get out of the private mortgage insurance at some point. Now, with FHA, it's actually for the life of the loan. If you pay anything less than 10% down, you will carry PMI for the life of that loan. Same thing with RD. It's for the life of the loan. Now, the one caveat with FHA is if you pay 10% or more down, you have to pay the PMI for a period of 11 years, but then it will go away. Where you're looking at or comparing that to conventional is, say you pay 10% down on a conventional loan, you may only have to pay the PMI for 7-8 years. So you've got to determine financially what makes more sense. And that's obviously something that we'll do here, but that's a big difference between those products and why we look at them. Because most people are like, well, why would you even look at a conventional loan? Well, that's why. If you want to see long term, what's the best thing for you to do? And because we look at a short term goal and we look at a long term goal when we're looking at these loans. Short term, we're going to look, if this is your first home, there's a pretty good chance that you're going to buy another house in the next 5 to 7 years. So you got to take that into account. If this is going to be your forever home, then we're going to look at it in a different way again. And, hey, long term, what do we do? Because you'll probably refinance. I mean, really, it's what keeps us in business, the way that rates circulate. We do a lot of refis as well as purchases. You're probably statistically going to refi or sell or do something different in every 5 to 7 years. It's pretty standard. Like I said, if the rates go down, you may refinance 2 or 3 times. And what we always tell people is it's incredibly easy to get you from 30 to 20 years and not mess with your payment a whole lot, especially if we're able to get rid of the private mortgage insurance. But that's something that you'll be thinking about, and something that we'll discuss as our short-term plan and our long-term plan for your loan product. All right, so those are the 4 major programs: VA, rural housing, FHA, and conventional. I know it's a lot of information, so you may have to rewatch it a few times, or obviously you can call in here or email us and we'll clarify that stuff for you. But I do want to talk about another, it's actually one of our investors. It's Kentucky Housing. Now, Kentucky Housing is our state housing agency, and they actually offer loan programs. We do loans through them, and they do VA, rural housing, FHA, and conventional loans. What kind of sets them apart is sometimes their rates are really good, but also they actually have down payment assistance loans. So on an FHA loan or a conventional loan, you may not have the down payment, and you can handle an extra payment for the loan, but you don't actually have the down payment, then we can do a down payment assistance loan through Kentucky Housing. Really nice deal. You can get up to $6,000, and it's amortized, or the payment stretched out over 10 years. So it generally, makes the payment around $60, $65. So it's actually a pretty nice deal. So you'll have your primary mortgage, and then you'll have your down payment assistance loan. So pretty good deal. So that's something that we, like I said in the next video, that we'll actually, I'm going to dive into the payment itself, kind of break it down and show you what I'm talking about, and give you a couple of examples and a few rules that you can follow when you're kind of calculating a payment up. When you're sitting at home on your financial calculators and you're trying to figure out what or the payment that you can afford. So those are the major programs. That's the ones I wanted to go over today. I hope you found this video informative. If you don't mind, I'd love for you to share the video, like our Facebook page, check out the website, go to the YouTube page and actually subscribe to the page. You can comment on there. I have been checking that. I haven't had any comments yet, but I have been checking to see if anybody had any questions. Same thing on the Facebook post. We check those to see if anybody has any questions. So again, my name is Jimmy Kerr. I'm with My Hometown Mortgage at 3780 North Mayo Trail, Suite 201, Pikeville, Kentucky. Our number is 606-432-6832. You can call up here and talk to myself, Greg Lee, Ken Stein. Would love to help you. And I appreciate you guys, or whomever's watching it. I appreciate it. And you guys have a great day and a great rest of your week. See you.